Okay, so continuing the last part for ICDS, ICDS 5, tangible fixed assets. Now there is no major change or deviation in the valuation of the fixed assets as we've done. We've done all of this based on case laws. We know that if there is a subsidy that is received for purchase of a capital asset, it has to be reduced from the cost. We know that the money paid or payable, including freight inward, installation charges, etc., are part of the actual cost of the asset. We also know that if there is SENVAT credit available, that has to be reduced from the actual cost of the asset. If there are any rebates or discounts given, that has to be reduced. All of these are points mentioned in the ICDS. We also read that if there is an exchange, in case of case laws, we said that, for example, if I'm getting a capital asset in exchange for another asset, in that case, we take the market value of the asset on the date of receipt as the actual cost. So just going through the main points here, he says ICDS deals with the treatment of tangible fixed assets. ICDS 5, it contains the definition of tangible fixed assets, which we know tangible being land, building, machinery, plant, furniture, held with the intention of being used for the purpose of producing or providing goods and services and is not held for sale in the normal course of business. I think we know that. This ICDS provides components of actual cost of such assets and the valuation of assets in special cases. The fair value of tangible fixed assets acquired in exchange for shares or other securities or another asset shall be its actual cost. So I think this point you will remember. So if you've issued shares and the person has given you a capital asset, the market value, the fair value of that asset will be treated as its actual cost. So in exchange of shares or another asset. Of course, it provides for depreciation, but depreciation will be as we've done under section 32, shall be computed in accordance with the provisions of the Income Tax Act. The ICDS also contains disclosure requirements. So nothing life-changing there. Then we have exchange or the effect of changes in foreign exchange rates. So we have treatment of transactions in foreign currencies, translating the financial statements of foreign operations, and treatment of foreign currency transactions in the nature of forward exchange contracts. The ICDS requires exchange differences arising on settlement of monetary items or conversion thereof at the last day of the previous year to be recognized as income or expense in that year. Now ICDS 6 talks about effects of changes in foreign exchange rates. While doing business side, we discussed 43A. We said where an asset is purchased from outside India, then any change in the rate at the time of payment has to be adjusted in the year of such payment. Now ICDS 6 recognizes section 43A. That means nothing changes. ICDS talks about, one is transactions which are monetary transactions and the other are non-monetary transactions. Now for example, we are looking at monetary transactions are defined in the ICDS. We look at the definitions. He says, and this is definition given on page number 68 of the ICAI supplementary module, where you have all the amendments given. And I said we are not going to be reading page by page, line by line. We will do the relevant points. He says, are money held and assets to be received or liabilities to be paid in fixed or determinable amounts of money. Cash, receivables and payables are examples of monetary items. I think this you should know. Non-monetary items are assets and liabilities other than monetary items. Fixed assets, inventories, investments in equity shares are examples of non-monetary. Now he looks at recording of transaction, one on the date of transaction and the other is the adjustment at the end of the year. So we say initial recognition, a foreign currency transaction shall be recorded on initial recognition in the reporting currency by applying to the foreign currency amount the exchange rate between the reporting currency and the foreign currency at the date of the transaction. So whatever is the rate of exchange, let's say dollar rate, we are talking about 67.2 on 1/1/16 is the date of the transaction, and on that date, whatever is the amount, say you've imported stationery from outside India, so whatever is the rate of exchange on that date, you will apply it, but maybe you've not made the payment as yet. Then he says at the end of the year, at the last day of each previous year, foreign currency monetary items shall be converted into reporting currency by applying the closing rate. He says, now the closing rate does not reflect reasonable accuracy. Now we are not going to go too many details, but just to look at the final amount, he says, in respect of monetary items, exchange differences arising on the settlement thereof or on the conversion thereof at the last day of the previous year shall be recognized as income or as an expense in that previous year. In respect of non-monetary items thereof at the last day of the previous year shall not be recognized as income or expense of that year. Which means in case of fixed assets, we will apply 43A, which means we will make the settlement as on the date of payment. So any difference, whether gain or loss as on 31st March vis-a-vis the rate on the date of transaction, you will not adjust while computing total income in case of fixed assets, inventories, investments. But in case of monetary items, whatever is the adjustment, whether gain or loss as on 31st of March will be adjusted while calculating total income to be recognized as income or expense of that particular year. So I think that part you will keep in mind. Now ICDS 7, government grants, and I have a feeling that a question from this might be possible. The government grants we know can be called cash subsidy, duty drawback. We've done the treatment of the government grants under the head business and profession on a very simple level. If the government grant was for purchase of a capital asset, we know it will be reduced from the actual cost of the asset. If the grant was given for purchase of more than one asset, we will proportionately reduce it from the cost of the asset. If the grant was for working capital, we will treat that as income. Now the ICDS more or less agrees with what that is. But we are looking at when to recognize government grants as income. We all know that there are certain conditions a grant will carry. So if the government is going to give you a grant, there will be certain conditions which you need to fulfill. So as per accounting standards, if suppose I receive a government grant on 1/3/16, I have received the money, but the fulfillment of conditions regarding this is still not reasonably certain, which means it's not certain that the conditions will be fulfilled by the assessee. Then according to accounting standard, this government grant may be treated as income of that year in which there is a reasonable certainty of the conditions being fulfilled, which means you do not need to treat that as income of 15/16. Now ICDS agrees with that and says that if there is a reasonable certainty of conditions being fulfilled, then the government grant will be treated as income of the year. However, ICDS एक बात और बोलता है. It says that the recognition of income by way of government grants cannot be postponed beyond the date of receipt. Which means in this case, if I have received the government grant, even if there is no reasonable certainty of me fulfilling the conditions, this will still be treated as income of the year of receipt, which basically comes down to the same point that ICDS are trying to prepone the liability to income tax in most of the cases. Now, let's look at the wording. So, ICDS deals with the treatment of government grants, ICDS 7. It recognizes that the government grants are sometimes called by other names such as subsidies, cash incentives, duty drawbacks, etc. The ICDS does not deal with government assistance other than in the form of government grant and government participation in the ownership of the enterprise. It requires the recognition of government grants when there is a reasonable assurance that the person shall comply with the conditions attached to them and the grant shall be received. However, it also states that recognition of government grants shall not be postponed beyond the date of actual receipt. This is what I said was the important part. The ICDS requires that government grants relatable to depreciable assets to be reduced from the actual cost. It further provides that where the grant is not directly relatable to the asset acquired, then a pro rata reduction of the amount of grant should be made in the same proportion as such asset bears to all the assets with reference to which the government grant is so received. So we've talked about that even during the course. The standard requires the grants relating to non-depreciable assets to be recognized as income over the same period over which the cost of meeting such obligation is charged to income. So for depreciable asset, we reduce it from the cost. With regard to non-depreciable assets, to be charged to income proportionately. The standard also requires government grants receivable as compensation for expenses or losses incurred in a previous financial year or for the purpose of giving immediate financial support to the person with no further related costs to be recognized as income for the period in which it is receivable. Now, what we are going to look at is the difference between AS12 and ICDS 7. I have already discussed this with you. All I am looking at is reading what is given in your amendment module, supplementary module. This is on page number 87. So this is on page number 87. We are reading from there. Recognition of government grants. AS12 provides that government grants should not be recognized until there is a reasonable assurance that enterprise will comply with the conditions attached to them and grants will be received. Paragraph 4 of ICDS 7 also provides should not be recognized that until there is a reasonable assurance that the enterprise will comply with the conditions attached to them and the grants will be received. The requirement is in line with AS12. However, paragraph 4.2 goes on to provide that the recognition of government grants shall not be postponed beyond the date of actual receipt. Therefore, as per ICDS 7, initial recognition of government grants cannot be postponed beyond the date of actual receipt, even in a case where all recognition conditions in accordance with AS12 are not met. As I said earlier, I am assuming you've done your accounting standards. There is no point in repeating the same. Treatment of government grants of capital nature and government grants in nature of promoter's contribution. AS12 permits government grants in the nature of promoter contribution, that is, grants given with reference to the total investment in an undertaking or by way of contribution towards its total capital outlay. For example, Central Investment Subsidy Scheme is to be treated as a capital research which can neither be distributed as dividend nor considered as deferred income. ICDS 7, however, does not contain specific requirement to capitalize government grants in nature of promoter's contribution. Therefore, they have to be treated as income, except in case of government grant relating to depreciable asset which is to be reduced from written down value or the actual cost. All other grants have to be recognized as upfront income or as income over the period necessary to match them with related costs which they are intended to compensate. So that is the difference between the AS and ICDS. And ICDS also somehow partially overrides one of the Supreme Court judgments. So he says the requirement in ICDS 7 to recognize such grants as upfront or deferred income is not in line with the rationale of the Supreme Court that the purpose of the grant would ultimately determine its nature. Now that's a question raised in the RTP. If I look at the RTP, the first question says, that's a question on basic concepts. It says the object for which the subsidy assistance is given by the government determines the nature of the subsidy, the purpose for which the subsidy is given, whether it is revenue or capital. Discuss the relevance of the rationale of Supreme Court ruling in Pune Sugar Mills in respect of such subsidy received on or after 1/4/15. So 1/4/15 is relevant because before that ICDS were not applicable. So if I look over here, he says the Supreme Court observed that it is the object for which the subsidy or assistance is given which determines the nature of the incentive subsidy. If the object of the subsidy scheme was to enable the assessee to run the business more profitability, then the receipt is revenue. On the other hand, if the object of assistance under the subsidy scheme was to enable the assessee to set up a new unit or to expand the existing unit, then the receipt of subsidy was on capital account. So the nature or the object for which it was given would determine whether it is revenue or capital. In line with the requirement of ICDS 7, new subclause 17 has been inserted in definition of income under 224 to provide that assistance in the form of a subsidy or grant or cash incentive or waiver or concession or reimbursement by whatever name called by the central or state government or local authority or agency in cash or kind to the assessee would be considered as income. It is only subsidy or grant which was taken into account for determination of actual cost of the asset which would not be considered as income. So now we have only two types of treatment for ICDS, and this might be important. Whereas the Supreme Court said if it was to set up a business, capitalize it. If it was for a running business, treat it as revenue and income. ICDS says treat it as income. It is only if it is for the purchase of a capital asset do you reduce it from the actual cost and not treat it as direct income. In all other cases, you treat it as income. So ICDS 8 now. We're looking at valuation of securities which are held as stock in trade. So this one is only talking about valuation of securities which are held as stock in trade. 1. The securities need to be recognized at the actual cost on acquisition, which shall comprise of the purchase price and includes any acquisition charges like brokerage, fees, tax, duty or cess. But that is what we've already done. The actual cost of a security acquired in exchange for other securities or another asset shall be the fair value of the security so acquired on the date of its acquisition. Subsequently, at the end of any previous year, securities held as stock in trade have to be valued at actual cost initially recognized or net realizable value at the end of that year, whichever is less, which is in tune with valuation of any stock. It is cost or net realizable value, market value, whichever is less. It goes on to say, and here is where the difference and the important part comes, that such comparison of actual cost initially recognized and net realizable value has to be done category wise and not for each individual security. Now we can take a small example saying if we are looking at equity shares. Now he says category wise. The ICDS goes to define the categories of securities into 4 parts. One is shares, the other is debt securities, the third is convertible securities, and the fourth is others not covered above. Which means if I am looking at all equity shares here, they belong to one category. Now ideally if we were doing it, we would have said if this is the cost of each security and this is the market value as on 31st March, then we would have said whichever is less would amount to, so I get 362 as the valuation of my closing stock. But now he says do it category wise. So if I do the total here, so cost or net realizable value whichever is less comes to 392, and as you can see the valuation has increased in this particular example, and because of increase in value there will be increase in profits, which might not exactly be in tune with our philosophy of not recognizing notional income, but of course taking into consideration notional loss. But if you do it category wise, some gain will be offset by some loss, and in the end the net valuation could be higher. So ICDS, as you can see, is trying to ensure that every assessee pays a little more by way of taxes. So he says manner of composition. Now we are on page 89 looking at the comparison. The manner of comparison of cost and net realizable value for valuation held as stock in trade, category wise and not for each individual security. This is a deviation from judicial precedents. This requirement in ICDS deviates from the judicial position that anticipated profits should not be taken into consideration for valuation of closing stock. The Supreme Court in case of UCO Bank Limited versus CIT observed that it is not proper to take into account anticipated profit in the shape of appreciated value of closing stock, as no prudent trader would show increased profit before actual realization. This is in theory underlying valuation of closing stock at lower of cost or market price. We know that. The requirement in ICDS 7 to compare the actual cost and net realizable value category wise, in effect, results in recognition of anticipated profits, since rise in value of some securities will absorb the decrease in value of the remaining securities in the same category. So we are on the 9th ICDS, borrowing costs. What do you do with the interest? He says deals with the treatment of borrowing costs. It does not deal with the actual or imputed cost of owner's equity or preference share capital. It requires borrowing costs which are directly attributable to the acquisition, construction or production of a qualifying asset to be capitalized as part of the cost of the asset. Other borrowing costs have to be recognized in accordance with the provisions of the Act. Qualifying asset has been required or defined to mean land, building, plant and machinery being tangible assets, know-how, patent, copyright, trademarks, license, franchise or any other business or commercial right being intangible, and inventories that require a period of 12 months or more to bring them to a saleable condition. Which brings us to a point, when we were doing section 3613, we were talking about interest on money borrowed. Interest on money borrowed. हमने कहा था कि if there is interest and before the asset is put to use, after the date of asset being put to use, we know as per explanation 8 to section 43(1), this is revenue. But before this date, if it was for expansion of business or extension of existing business, only then was it to be capitalized, else not. Now with the introduction of ICDS, which does not talk about this particular clause, section 3613 has also been amended and provide that statement deleted, which actually now means whether the new asset is purchased for extension, expansion or otherwise, this has to be capitalized. That is one now. So that's an important part. After the date the asset is put to use will always be revenue. Now, in case of accounting standards, now we're going to look at what accounting standards say and what ICDS and how do they differ. In accounting standards, there is this condition that you capitalize the borrowing costs if the asset is going to be taking approximately 12 or more months for it to be put to use, whether it is land or building or plant and machinery. So if the asset is going to take a long time for installation, then you will, or bringing it to use, then you will capitalize. Now ICDS does not talk about the period of 12 months for land, building, plant and machinery or the intangible assets. It is only talking about that for inventories. So he says minimum period for classification of asset as a qualifying asset. As per AS 16, qualifying asset has been defined to mean an asset that necessarily takes a substantial period of time to get ready for its intended use. AS 7 clarifies that ordinarily a period of 12 months is considered as substantial period of time unless a shorter or longer period can be justified on the basis of facts and circumstances of the case. ICDS does not provide any minimum period for treating an asset as a qualifying asset, except in case of inventories. Consequently, borrowing costs in respect of assets have to be capitalized even if assets, a land or building or plant and machinery, does not take a substantial period of time to get ready for intended use. So that I think we've never mentioned 12 months in income tax. So that is in tune with what income tax had earlier been doing as well. We also know if I borrow money and temporarily invest it in a FD, the interest that I get has to be treated as income from other sources. It cannot be reduced from the cost of the asset. We've done this when we were doing the discussion of actual cost in business set. The same thing is mentioned here now. We say paragraph 11 of AS permits income earned on temporary investment funds pending their expenditure on qualifying assets to be deducted from borrowing costs incurred ICDS, however, does not permit such reduction from borrowing costs, which means the income that is coming, if I invest, okay, let's take a small example here. I say I have borrowed 10 lakhs and I'm paying interest at the rate of, let's say, 12%. I'm getting, or I'm paying 1,20,000. Maybe I invest this money for a period, a short period, and I earn interest of, let's say, 30,000. Now, do I reduce this 30,000 here and get 90,000? Or do I treat this as income? Now, that is going to affect your tax liability, because this is not going to directly affect the tax liability. So, this will be capitalized and a deduction by way of depreciation is going to be allowed on it. So, 30,000 by way of reduced depreciation will be income over a period of time, but over here this will be treated as income immediately. So, that's one deviation. The last of the ICDS, which talk about recognition of provisions, contingent liabilities and contingent assets. Well, for one, we know that income tax does not recognize provisions or contingencies. We need to take into consideration expenses when they are actually incurred, or income when we actually earn it. Now, ICDS talks about the same things, but just a comparison between AS 29 and ICDS 10. AS 29 requires recognition of a provision when it is probable that an outflow of resources embodying the economic benefits will be required to settle the obligation. So, probability, it is probable that I will be paying the money, then it recognizes that as an expense. ICDS, the wordings are recognizes or requires recognition of provision only when there is a reasonable certainty that an outflow of resources will be required to settle the obligation. As I said, the obligation should be in present. The requirement of reasonable certainty in ICDS 10 to recognize provision is more stringent as compared to the requirement of probability, which might delay the recognition of an expense, thus preponing income. So, this will have the effect of postponing recognition of provision for tax purposes and consequently result in earlier payment of taxes. Similarly, we are talking about contingent assets. AS 29 says, if inflow of economic benefits is virtually certain, ICDS 10 says, is reasonably certain. So, while allowing a provision for an expense only when you are reasonably certain here, but recognizing the income not when it is virtually certain but only when it is reasonably certain, thus preponing recognition of income and postponing recognition of expenditure. Though I do believe the word reasonably certain will have to be defined and debated upon. What we've just done is a summary of the ICDS. Now, I would want you to just try and keep these summaries in mind, the main points that we've highlighted. There's one more part to these amendment notes, which I will look at all the balance small amendments that we have to do for the papers. So, take care.